There's a popular game called Would You Rather, and it paints two hypothetical scenarios against each other. And today we're going to play retiree Would You Rather, specifically early retiree Would You Rather. The question is, would you rather be saving $600 a month now for the next 2 years, or save hundreds of thousands at the end of your retirement, which could be 25 to 30 years later? Now, again, we're talking a much larger number over a longer period of time, or we're talking about immediate savings today. I think there's something to be said for trying to split the difference and seeing if you can do both. This is what a lot of retirees are facing when it comes to early retirement and the Affordable Care Act exchange, otherwise known as the Obamacare exchange, and looking to complete Roth conversions in their early gap year. Now, the purpose of the video today is actually to cover some of the specifics of the planning and the choices that you need to end up making here. Now, due to the passage of the One Big Beautiful Bill, there are going to be some changes starting in 2026. So that's something to keep in mind if you're planning to retire prior to Medicare eligibility and you need to find a solution to your health insurance. If we've not yet met, my name is Danny Cieniewicz. I'm a CAP professional from Hyperion Financial, and we've helped dozens of retirees make this decision in order to understand a better idea of Roth conversion planning versus the ACA planning. Be sure to check out a quiz in the description below. If you fill it out, we'll be able to send you a personalized video that'll go through ways in which you can best make sure that you're able to maximize your Roth conversion planning, but also minimize the cost if you're planning on the Affordable Care Act exchange. Let's talk through a sample couple here, and we'll go through Mr. Fred and Joan Harris's situation. Fred is retired. He's age 65, so he is Medicare eligible. Joan, however, is only 63, so she has a couple years before she is Medicare eligible. We're going to assume that they don't have the option of utilizing COBRA and an HSA, which again would be something that they could utilize if that they could so choose. But let's just say they decide to go on the Affordable Care Act exchange and they have about 2 years to cover some of the premiums in order to make sure that they're able to utilize this plan. Understand that while we're talking about this couple, one who is Medicare eligible and one who is not, you can essentially double the amounts of the premium savings and the Roth conversion amounts in the event that they were both under the age of 65 and thus not Medicare eligible. But again, let's assume that Fred is Medicare eligible and Joan is not. Now, to briefly introduce Fred and Joan and some of their background, they both come from successful business careers. They've combined about $1.7 million inside of their 401ks. They also have about just shy of $300,000 inside of a taxable account. Joan does have some HSA dollars, and their concerns as they approach retirement are to make sure that their taxes stay low, but also to make sure that they have a plan for their health insurance, thus creating the dilemma that we talked about in the very beginning of the video. They're looking at living expenses between $125,000 to $135,000 per year in retirement, at least in the early going here. So making sure that they have a plan to cover this in conjunction with the type of plan that they decide to utilize. And this is going to lead to some of the decisions that are going to need to be made. For those familiar with this position, they're at a crossroads. The first option would be to keep their income low to qualify for Affordable Care Act subsidies. The second option would be to consider more of an aggressive Roth conversion strategy, specifically now, while they're in some of their down years, and making sure they're able to convert as much as possible to avoid future RMD problems and stealth taxes down the road. Would you rather be focusing on saving dollars now in retirement in the case of premium tax credit dollars, or would you rather be saving dollars inside of a Roth account to utilize 25 to 30 years in the future and potentially pass along to the next generation? If they decide to go this route, they're naturally going to need to keep their income low. And due to the One Big Beautiful Bill, starting in 2026, they're going to need to make sure that they stay below 400% of the federal poverty level. Being that this change is now going back to the old way, in which case the American Rescue Plan and the Inflation Reduction Act changes are no longer relevant, they now need to make sure that they stay off of the cliff. In other words, they stay below 400% of the federal poverty level. So if that's the case, they got to look to make sure they're able to keep some of their earned income low. Now, with Fred collecting a pension, they can look to utilize other sources of income, such as their non-qualified brokerage account, some of their savings, and they do have small Roth balances that they could actually look to utilize as well. Now, I'm going to show you one of the calculators that we use to help determine what some of these figures are, and it's a free calculator. I'll put in the URL in the description. One thing that I think a lot of folks want to know is, well, how much would the premium savings be if I keep my income below a certain threshold? The only caveat I will mention is that this calculator is for 2025. In 2026, the enhanced premium credits are going away, along with the 400% poverty level cliff. So, as a result, we want to just make sure that we're doing our best to understand that this could be changing. But let's say you can pick the state in which you live, enter in your zip code, your county will automatically show up. If you have your household income that shows up here, you can either do that at a percentage of the poverty level. Let's say that the spouse is not available. In this case, Joan is not available to take advantage of Fred's coverage because Fred is retired. There are two people in the household, one adult, and she is age 63. There are no children. We're going to click the submit button, and it'll tell us exactly how much the income is equal to the federal poverty level. It'll also give us the estimated financial help subsidy available if we decide to go on a silver plan. So as a result, this almost $600 a month amount would take place for the next 2 years. You can see what the net cost of a silver plan would be per month. Now, without any financial help, you're talking over $1,000 a month that Joan would have to pay. So you can see the benefit of trying to keep your income low. Now, something else that's going to be important to understand, and something that the One Big Beautiful Bill did do, which I think is a positive, is it did allow bronze plans through the ACA to be eligible for HSA contributions. Being that this is the case, all plans now eligible for HSA contributions, you can lower your adjusted gross income by making these contributions to an HSA. By making this contribution, not only will you lower some of the income in that year, thus potentially helping the fact that you could end up qualifying for this type of subsidy, but the other factor that's at play is that you can utilize these dollars tax-free if you do have a medical event throughout the year. So for Joan, if she finds herself in position where she's going to need to take out a distribution from her HSA, she can get the tax break as she puts the contribution in, and she can take it out tax-free. But now what about Roth conversions? What does this mean, and how is this going to affect the Harrises for their future income? Being that they're not going to be looking at complete Roth conversions during the ACA planning years, this is going to cost them potential to recognize dollars at a known lower rate versus in the future when their RMDs could be more substantial and frankly at an unknown rate. We don't know if tax rates are going to go up or down into the future, so it's impossible to say whether this move is worthwhile or not. However, what we can look at is what are rates at right now, and what would this look like if they decide to do this, assuming rates would stay the same. Now, for Fred and Joan, in this case, what we're looking at is some of the Roth conversion strategies over the course of their entire lifetime. And let's just say, for example, that they pursue an aggressive Roth conversion strategy over a 5-year time period. They'd be foregoing the first 2 years in the event that they decide to continue on with the ACA planning. But in the next 5 years, they would go with more of an aggressive Roth conversion strategy. This would be done in conjunction with the fact that their RMDs and then Social Security would kick in some of the later years here. So while they're in their lower income years, they'd take advantage of this Roth conversion strategy. If they were to utilize this compared to just their base plan, they would be saving quite a bit of their overall portfolio assets and decreasing quite a bit of the amount of tax that they would pay. Assuming that is the case, they'd be looking at a substantial amount of tax savings. But let's say they decide to utilize the Roth conversion strategy for those first 2 years and utilize a similar strategy, just like we talked about, but in this case, not worrying about the ACA premiums. Therefore, they would pay the full almost $12,000 a year of health insurance coverage rather than looking to take advantage of some of the subsidies. If that's the case, they'd be looking at almost $300,000 of taxes saved over the course of their lifetimes. And as you can see there, it does lead to more dollars that are accumulated over time if they're able to take advantage of a Roth conversion strategy. Now, if they don't consider a Roth conversion strategy, or if the vast majority of the money is all in pre-tax, they could find themselves paying higher Medicare premium surcharges over the course of their lifetime. They could eventually find themselves crossing the net investment income tax threshold. As a result, that would be an additional 3.8% tax on some form of their income. And again, this doesn't include any future taxes that could potentially take place. When it comes to the amount of time between now and then, if it's better to have dollars in a Roth or inside a traditional, it does depend on the tax rate at the time. Tax law can change significantly. Higher income earners are those who are not getting as favorable treatment. It might be worth considering Roth conversions. Is it possible to consider some strategy of taking advantage of both? This is where the nuance can be created. Here's what we should talk about as far as strategies that the Harrises should be considering, and frankly, what you should be considering if you find yourself in this similar boat. Number one would be CA planning. Do you have an idea of what your income can be and what it should be when it comes to 2026 and beyond, or even for this year, 2025, and how that compares to some of your expenses? If you can utilize some after tax sources or potentially even Roth sources in retirement and cover you before you're age 65 and on Medicare, that might be something worth pursuing. If that is the case and you're able to utilize this could offer an opportunity to consider Roth conversions. Now, one thing you want to make sure of is if you're planning to do this with that 400% federal poverty level cliff, that you do have an understanding of what income is taxable and what income is not taxable. If you have Social Security, for example, the more ordinary income you bring in, that can drive up your Social Security income. So therefore, you need to make sure that you have a strategy. Considering the fact that the one big beautiful bill allowed all bronze plans to be eligible for HSAs, that's a way in which you can lower some of your modified adjusted gross income and potentially keep yourself below the federal poverty level. This type of planning should be considered along with other factors, which again, depending on how much income you're bringing in, are you able to do a smaller Roth conversion in the next year or two? Do you live in a state where you also are going to be affected by Roth conversions? And as we've talked about before, state tax is such an unknown variable depending on the type of state that you're watching this from. Therefore, having a plan in place to cover for state tax, for some of the Affordable Care Act planning, and ultimately the long-term picture of your goals is vitally important. We need to understand that there are short-term goals and long-term goals at hand here. And good financial planning involves balancing those two and understanding that decisions that you make today are going to affect how you live tomorrow. If you need help with these questions or you're not quite sure, the team at Hyperion Financial can help. We offer a free financial assessment, which will help answer some of the pressing questions in which you may have. It's going to go through your specific situation and give you an idea of some of the factors that you should be considering, along with some of the recommendations that could be considered, and many of the things that you should be considering, not just now, but in the future. Lastly, as we've talked about with RMD planning, the longer that this continues to grow, and the longer that you avoid this problem, the more problems that it can create as a result. Check out this video right here if you'd like a better idea of how best to handle your RMD and to avoid some of the problems that can take place.